products, services, components of manufacturing loans, they're all going to change over time, just like any vendor or any, tech offering. But at the end of the day, liquidity is king.
Hey folks, hopefully my voice sounds familiar. I'm Clayton Collins, the CEO at HousingWire, and I'm back to host an episode of Powerhouse. Today I have an awesome friend and industry expert who has done some incredible things in housing and mortgage, Jen McGuinness. So Jen has been around Wall Street and the capital markets world of mortgage for quite a bit. She's been at Deutsche Bank and Corvest. She even spent some time at Premium Point Windwater, where she built the first hedge fund that issued AAA RMBS. Her expertise ranges from origination to capital markets to technology to credit data. And we hit a lot of those topics in today's conversation. We start out with non-QM. We end with frameworks for securitization. There is a lot of knowledge in here that applies to leaders in the mortgage industry, originators, and folks in real estate who are out there trying to work with home buyers who may need more creative product in the future. I hope you enjoyed this conversation with Jen McGuinness, the CEO of Pivot Financial. I am shaking off the cobwebs here. It's been a bit since I recorded an episode of Powerhouse, but today, Jen, thank you so much for joining me back on Powerhouse, the podcast that I started, and I'm thrilled to be back on the air with you.
Well, I am honored to be the first guest that you are interviewing in a long time, and God knows you don't have cobwebs. You're just a busy guy.
No, but I do have cobwebs on like the podcast hosting. I literally had to go pull this mic out of a box and get ready for this one. But I'm excited and I am energized, and we're recording this episode on Halloween Friday, October 31st. But we're gonna keep this optimistic and not make it too scary, despite being Halloween. Does that feel like a good path?
Yeah, absolutely.
All right, Jen. So we've been on stages before at HousingWire events. We've done lots of content. So I want to jump right into this conversation with you and talk about non-QM. So we just came out of MBA Annual a few weeks ago and the HousingWire Mortgage Banking Summit. And the topic of non-QM is on a hot streak. What's pushing non-QM into the spotlight right now?
I think product diversification, right? And being able to serve your entire customer base as a lender is making non-QM more and more important. I mean, if you think about it, non-QM has always been important, right? It's really just non-agency product. Yes. And I think that sometimes it gets a bad name where people call it subprime. This is not subprime. This is non-agency, alt-A, alt-B at best from yesteryear. And, they're prudent products and necessary for liquidity and borrowers getting the lending products that they need.
Yeah, we've done a lot of content on non-QM over the years with experts from Deep Haven and Angel Oak and yourself. And the that comment that non-QM is not subprime is something that I feel like we keep having to address year in and year out. So for the uninitiated, the folks who haven't heard this story before, what are the products that fit inside of this non-agency / non-QM category?
Yeah. So, you're going to have jumbo loans. You're going to have first lien non-QM. So let's call it a bank statement underwrite loan, or quite frankly, just slightly a step out from agency allowables. You're going to have first and second lien HELOC. You're going to have DSCR, bridge, fix and flip, ground up construction, business purpose loans. And, you'll have a couple other little products here and there. But, I think that, the market kind of goes, should we do these? Because they hear one bad story here and there. Look, in any product, there's going to be good and bad underwriting guidelines. And lenders just need to make, prudent decisions on which products they're choosing to originate.
We've heard talk tracks from originators that want increasingly diverse product suites, like you just mentioned. And we've also heard from other lenders who say, hey, my superpower is being, really focused in a tight lane. We've also heard that narrative change at different points in a market cycle based on origination volume and interest rates. What do you think is driving originators to seek this more diverse product suite today? And are there specific products inside of the non-agency suite that are really gaining the most traction?
Yeah, I mean, I think originators are finally coming to the conclusion that if they don't start to offer a more diversified, menu of products, that they're not going to be able to hit their volume targets nor
Yeah.
service the customer base in the geographies that they're located most effectively and efficiently. The other thing is, I think this took as long as it did in some instances because the lenders really got to become an AUS only world, and most of their underwriters became an AUS automated underwriting system only set of underwriters. Certain non-QM products are still an overlay with AUS, excuse me. Some are not. You really need to manually underwrite some of these products. So, I always say, and I've been quoted saying this a lot, like get back to underwriting loans for real. Okay. The GSEs, just because you have a DU approved eligible doesn't mean that if you check the boxes on that, DU that your loan is going to qualify. You got to look at their, seller servicer guide as well. So I think that's important. Products that I think are very important today. I know everybody's a huge fan of that second lien HELOC. First lien HELOC, in my opinion, needs to become a much larger focus. A little self-serving because we do first lien HELOC, but we do second lien HELOC as well. But first lien HELOC, if you really think about it, first lien and only lien on the property, right? You could be done for purchase, rate and term, or a cash out refi. But if you pay down your balance, you can still draw it up over the course of 10 years. Now think about that in like a COVID scenario. Instead of people having to leverage, their 20-something% credit cards, they may have been able to leverage, their, at the time, 6% first lien HELOC, right? 7% first lien HELOC. That's a big game-changing feature. And it's, also more like a cash management account. With regard to, non-QM, other types of first liens, dynamic income exists, and the GSE protocols don't always work well with it. Understanding self-employed or heavy commission-based underwrites. Quite frankly, non-QM products are also 2-year tax return products, very similar to GSE products at times, but maybe have slightly more give. But that give isn't necessarily a bad thing, right? It's maybe just something that's a little bit more detailed. But trust me, the large majority of the non-QM products, if they take a little bit more credit risk in one aspect of the guidelines, they're insulating for that risk somewhere else in the structure of those loans. So again, they're prudently underwritten loans. And if you take the time to look at the stats on the loans, a lot of the time the non-QM credit characteristics are significantly better than the GSE, Fannie, Freddie characteristics of loans. The actual max LTVs are not as high. I mean, Fannie Freddie goes over 100, right? There's no over 100 non-QM product, right? And based on primary, second, and investor, you see restricted LTVs. And listen, everybody likes to talk about underwriting guidelines and secret sauce. What happened in the '08 housing crisis? What was one of the most important things that you needed to have to be insulated? Your valuations needed to be correct. Because at the end of the day, in a doomsday scenario, and there wasn't a doomsday scenario everywhere then, that's what you got. You have a house, okay? And that's what you're going to have to liquidate in that doomsday scenario. So I think let's focus on that a little bit, right? So the market needs to, understand the credit world again, not, oh, well, there's an implicit guarantee from, the GSEs, so let's just buy it up no matter what the credit characteristics are.
So you mentioned the first lien HELOC. So from the originator point of view, who is a first lien HELOC a strong product for? Does that need to be the homeowner who's already paid off their mortgage or was a cash buyer?
No, you can, like I said, you can do a purchase with a first lien HELOC, a rate and term refi, or cash out refi, right? You don't have to use the optionality of a first lien HELOC of being able to take additional draws, but think about the fact that you can. So instead of going out and taking out a personal loan, or instead of getting a second lien HELOC at a higher rate, right? Now you got one payment. If you pay that balance down, that payment's going to come down with it. If you need a little bit more money because, I don't know, your water heater broke or something like that, and you don't have enough cushion, now you can take that from, your first lien HELOC for that 10-year duration. And I think that's important. Also, most first lien HELOCs are 10-year interest-only loan. Lots of people go, oh my God, the rise of the interest-only loan again. Guess what? I don't care what product we're talking about. I don't care what duration. All loans generally last 7 to 11 years on average. Let's stop spooking ourselves on things that are not spooky.
I see what you did there. That's spooky on Halloween. I got it. I got you,
Yeah,
Jen.
I'm going to give you that's my ghosty of the day.
So, all right. So historically, depositories, the depository banks have been really strong on the HELOC side. We have seen some of the IMBs and wholesale lenders start to introduce more home equity products. Tell us about that trend. What are we seeing there, and how are they doing that?
Well, one of the reasons they were locked up in, the banks themselves is because they had a very wonky sweep account structure where, the mortgage lender needed to sell a bank account in order to actually get those draws through. Years ago in 2018, we built a custom servicing structure for it where you don't have to sell a bank account. And I think that's very important. Now a borrower can just, interact with their servicer on these products. And I think that's an important feature. Again, it's just like a first lien mortgage, but you have much better optionality.
Yeah. I'll bring it back to an earlier comment you made about like serving the borrower. And it feels like, in this environment where homeowners are staying in homes longer, significantly longer than they have historically, the access to equity has become an increasingly important consumer demand. And if the IMBs aren't able to help with that, that's a relationship that's potentially walking out the door and killing potential for recapture at refi as those those borrowers go elsewhere.
But I would add I'd add one thing there, and I would say not everybody should go take out only a second lien HELOC. I think LOs and lenders also need to do the work. Everybody says, oh, we need the second lien HELOC because everybody's got a 3% rate. Well, even if you have like a 3 or 4% rate, and you're going to go take out that second lien HELOC, if you blended that balance in the rate market we're in today, you may actually be better off refinancing that first lien. And I think everybody just looks at it kind of like sticker shock, like if you're in Walmart and you see like, a blue light special on, line 2 or whatever. Like just because you have 3% rate doesn't mean you want to go take out this, higher rate product. Let's call it an 8. Blend them together, you're going to be better off refining that first lien.
Okay.
Do the math, everybody, and teach your clients, how these things really work. One of the things I'd love to see happen in mortgage, and I talk about this all the time, how if you're, working with your investment manager, they ask you, what's your risk today? When are you going to retire? If you're older, they tell you to go a little bit into lower risk assets. Well, have that conversation with your borrower. What are you thinking about this house? Like, are you being relocated here, only to work here for 3 years? And, therefore, in 3 years, you're planning to sell this house and move. What are you really looking to do with this? And to touch upon what you asked me, which I didn't answer earlier, yes, people are staying in their homes longer, but it's not always your first borrower. There's been a lot of generational, share of homes, where the parents are a little bit older and then the kids take over the primary residence. But I think you have to keep in mind, but that doesn't mean that the kids, while the parents are alive, have, the open, carte blanche to go refi that house. So I think we also need to, think about those things as well. Is it really that original borrower is staying in the homes longer? Or is it really that you're seeing that, enhanced well from people that have let their 35-year-old children continue to live in the home? See where I'm going?
Such a important and interesting topic. We just had our Focus on Excellence home builders conference out in Denver earlier this week. And one of the hot topics with home builders right now is how much demand for certain types of inventory is changing. And like the industry has wanted to talk about the need for affordable housing, which builders and a lot of people have equated to smaller housing, like 2 twos, and builders are seeing the opposite shift right now. The demand is coming for larger 3 and 4 bedroom houses because one, people have waited longer to buy their first homes. So they're more likely to have a family or be starting a family when they are moving into that first house, or they're multi-generational living. So like the quote unquote affordable like 2 twos is not the product that's in demand by buyers, and builders are really having to contend with like this like kind of narrative gap that like, hey, if you want affordable, it needs to be small, but people don't want small.
Yeah, no, I mean, from the builders that we know and we work with, the average house has now become a 3, 2.5,
Yep.
right? So they want that at least 3 bedrooms, 2 bathrooms, plus the half bath. And, I think that's very important. And it's awesome that you talked about that at the launch of the builders. And congrats on that, Clayton.
Thank you. It was cool. You would like this event, Jennifer. It was I've been to builder shows before, and it's about like, you know, innovation in like in roofing materials or like insulation, and this was not that. This was a kind of a finance event, and like
Hmm.
everybody, like the topics were debt capital markets, equity capital markets, M&A, margin management. It was a sophisticated group of private home builder owners, and then like the public co, like CFO, chief strategy officer types. But I was super impressed with the people who joined us for this one.
No, I think that sounds great. And we had a conflict, or maybe we would have attended, but next time we're in.
Well, we'll get you there. All right, so let's pivot over and talk about credit data for a minute. So when we were at MBA, I actually hosted a few podcast episodes with in the Equifax booth on the trade show floor, and I got to talk to leaders from Equifax, Experience, and TransUnion about VantageScore. But I think there's still some like elements of the conversation of like things that are being overlooked when the industry talks about the introduction of VantageScore under Pulte's directive and FICO Direct. So I want to get your perspective. What should lenders be paying attention to as the future of credit data makes a pretty significant change?
Well, I'm going to take that in 2 points because, there's obviously the credit score and then there's credit data as a whole. From a credit score perspective, I get why the market is saying, we need competition, bring in other parties like this and that. But I think that they're missing the boat on the fact that this is not competition, right? The same credit bureaus have been providing the credit data, and then FICO goes in, fixes all the problems with it, does additional calculations, produces the credit score, et cetera. Well, those same credit bureaus, so again, you see this? The same thing, credit bureau, okay? Now are the owners in joint venture on VantageScore 4.0, and then VantageScore is going in and creating, their score. Now, I think there are, in Vantage 4, there are some really good, optionality there. But I think, the market is not focusing on also the fact that FICO has a FICO 10T. So the weirdness here is that Pulte approved, Vantage 4, but at the same time, a couple years ago, FICO 10T and Vantage 4 were approved at the same time. But now the GSEs are building for FICO Classic and Vantage 4.0, right? And they're not the same thing, right? They have different, adjustments to them. They have different data components to them. So the first thing that makes absolutely no sense to me is why wouldn't you put two of the most recent models in play side by side? So my opinion is FICO 10T and Vantage 4, put them side by side, and now we have the more current models. So that's my first thought. Additionally, a 700 FICO from FICO or a 700 credit score and a 700 from Vantage 4.0 are not the same thing. The models need to be looked at. They need to, understand that. The other thing is there's, I forget what the exact verbiage is, but there's a quote going around, additional borrower inclusivity, I think is what they're saying, using Vantage because allegedly it's going to score borrowers and bring more borrowers to the lending market. Well, my question is just because you can score a borrower does not necessarily mean that that score is going to qualify them for a mortgage. So, I'm really one of those that gets into the weeds and gets black and white. My whole thing is let's stop with the big verbiage use cases here. And let's take the two most recent models, do the work on them, and really figure out who's adding the most value. The other thing is nobody's thinking about the downstream and the upstream impact of this change. The bond buyer has to get comfortable with new scoring tools, and they're going to need to understand if those tools are the same. Rating agencies putting out write-ups, just literally putting a footnote in the bottom that says, we just assumed that Vantage 4 and FICO's credit score is the same in this analysis, doesn't help anyone, right? Let's actually do the work and, and focus on that. The other thing, the evil, it costs too much factor, right? Yeah, well, if you combine all of the credit bureau data and then you throw FICO or Vantage's cost on top of that, right? It costs X dollars. But you have to remember that the third party aggregators selling it to you also are putting a spliff into that number. So there's the real base cost from the bureaus, there's the real base cost from FICO or Vantage, and then they're putting in a margin on top of that. It's kind of like appraisals. The appraiser does not get paid the dollar amount that the lender pays the appraisal management company. They're making a margin on that as well. So I think we need to tease that out. FICO put out that they're charging $4.95 a score. Okay. Then if you actually look, Vantage just decided they were going to undercut that. That's before this latest and greatest change. And they went, all right, ours is going to be $4.50. Guys, I mean, like, $1.20 across 3 scores is not going to move the needle on anything. And there's bigger fish to fry on the cost to originate. And then, with regard to FICO's new offering, the compilers are going to put it together. Great. My problem overall with credit scores is credit bureaus. Could we please get the data consistent and clean? Okay. If you look before, Trump started shutting down the CFPB, credit bureau and credit inquiry was one of the largest complaint pieces that the CFPB received. But instead of focusing on that and the fact that it increased almost 70% over like 5 years, right? They focused on getting more money out of the mortgage industry. So let's clean up the bureau data. For your humor, my own credit bureaus, one of the 3 in the tri-merge, says that I work at a job that I left in 2009. That's a problem when you're really using a credit score to be the predictability of, will your debt get repaid? The other thing is, if I see it one more time, if FICO's so great, why couldn't they have, predicted the housing crisis? That is not what credit scores do. Okay? That is not what we do with a credit score, right? So I think, hey, here's an idea for Clayton. Let's do a, webinar on what a FICO and credit score really is and what it should be used for versus what everybody keeps talking about. And I think that would be awesome. And I bet you would get a credit Vantage and FICO to take part in that.
Well, let's give it a quick punch right now before we move on and talk about, you mentioned the bond market. I want to get into securitization, but earlier you talked about like the importance of valuation. So like that we're underwriting the asset. Credit score is helping us understand borrower risk. Like when you say that the utilization of credit score is misunderstood, like how are lenders using credit score and I'm sure that answer is a little bit different across non-QM and agency, but just curious in your quick take there.
I mean, credit score will generally drive pricing categories for mortgages because it really is a predictor of possible risk of repayment or not, right? So a 660 FICO versus a 740 FICO is always seen as a different borrower type. But if we really, tease out the weeds, I'll tell you straight up that if all of a sudden you went and took your credit cards and took them to over 51% utilization, your credit score is going to swing by 100 to 200 points. And then if all of a sudden you paid it down, right, it's going to swing right back to where it was. Let's call it the high 700s range. So I think, look, there's work that can absolutely be done in credit scores. And I would love to see them actually put income data into credit modeling. But that is not what they do today. Right? They only look at, what has been your debt profile, what is your credit availability, what is your use of credit, and those types of features and how have you performed on that credit to then, actually produce that credit score. So again, but you have to understand that the models all have swings. Without additional data inputs that have never been considered in credit scores, it's not going to change. So, right. So I think that's important.
Is the bond market kind of on their toes with with knowing what to expect once we start to see securitizations?
Absolutely not. Okay. The bond market will start worrying about it when it really looks like it might possibly go live. Right. I mean, you do have the rating agencies putting out some write-ups on it, but the bond market's not going to worry about it until they actually have to take it into consideration on execution. And, listen, there'll be a couple research guys that'll disagree with me, that have been quoted on this. But the guys on the desks still pricing bonds today sees it as business as usual because they're not using the information now. Therefore, there's no need for them to focus on it.
So do you think, like, specifically in like small and mid-size lenders who I think you work with very frequently, are they going to have securitization challenges if they start originating VantageScore loans and the bond market's not ready for it? Or like, what does that world look like come 2026?
So today, we're very much locked in an aggregator model, right? So that smaller to mid-sized lender is generally selling their loans or delivering their loans. So they'll deliver them, the GSE, FHA, et cetera. Or they're selling their loans to, aggregators, whether you're a mid-sized aggregator all the way up to the largest aggregators. And those parties are then securitizing the assets. I think, no smaller or mid-sized lender is going to go 100% onto VantageScore unless the aggregators that give them liquidity today are going to say that it's okay, right? And I think that that's important. And the aggregators have to be thinking about it as well from their liquidity workout on that securitization model as well. If I make this change, what is going to be the outcome of the change? Will that change be priced in at some point? Will Vantage or FICO be seen as better or worse? I think there's a lot that remains to be seen on that.
So when I do these podcasts and I shake off the cobwebs, Jen, I always remember to ask my guests, if there's one thing we leave the show and don't talk about, what would you regret? And you quickly said a new securitization framework that you're working on at Pivot. Tell me about this securitization framework.
Yeah, so Pivot is working on a structure that will allow for that small to mid-sized lender and larger lender, but not the largest lender per se, to actually achieve securitization liquidity for themselves. We're going to marry multiple lenders together, and we're not going to do it in M&A. And we're going to allow them to issue their own bonds. And we're going to achieve a AAA rating. And you want to talk about competition in the market? That's how you do it. Okay? Products, services, components of manufacturing loans, they're all going to change over time, just like any vendor or any, tech offering. But at the end of the day, liquidity is king. If you can get liquidity as a smaller and mid-sized lender that's as good as those larger guys, it is game changing for the lending market and really important.
So does that mean, all right, so today that small mid-sized lender is going to sell to an aggregator. In the future, or when the Pivot securitization framework is in market, they have the option, hey, we could sell to an aggregator or we could partner with peers and securitize directly through this Pivot framework?
Right. And the best part about the new structure is the lender will take no additional risk than they take today. If they sell a loan, a non-agency loan, for example, to an aggregator, they all make reps and warrants, an agency loan as well, standard reps and warrants. Well, one of the things that bondholders or bond buyers, have, really focused on is get me diversification across lenders. Well, a lot of the time, even those larger issuers really are not achieving that diversification. They're buying a bunch of loans from another aggregator or a lender, but they're getting those loans from a bunch of other guys. But their real recourse risk is one place or maybe three, okay? But they tease out on purpose who the originators were so that to the bond buyer, it looks like a diversified, more unsaturated pool. Well, what I'm going to do is actually create that unsaturated pool where you actually have the right recourse to the right places to multiple lenders that are really going to stand behind those loans. And at the end of the day, that's actually the way this market should work.
So for the lender, does that result in better gain on sale margin, like pricing advantages? Like what's the financial benefit?
Like loan sale 101, right? If I'm the originating lender and I'm selling to a larger aggregator, do you think that the larger aggregator who delivers it to the GSE or securitizes it himself is doing it for free? Or do you think that the pricing differential is there so they make a significant margin? Well, I'm going to give the margin back to the guys that actually do the work.
Okay. Yeah, I mean, it's kind of similar to the conversation about the credit data providers. Nobody should be doing work for free. Like we don't expect FICO or the bureaus or the resellers to do work for free. But if there's an option to make a market more efficient, more direct, that takes a stakeholder out.
Yeah, and again, that's what the bond buyer wants. They want a diversified set of lenders. They want a diversified set of underwriting. And they want that, piece, right? And I think that's really important. The other thing, you just said the word for free. Just because somebody says the word for free out loud doesn't mean it's free. So for example, I forget which one of the bureaus came out and said, we'll give the Vantage for free. They're not really giving it to you for free because they're saying, we'll give it to you for free if you buy FICO. Well, guess what? The bureaus still get paid if you buy FICO. So let's be careful on what the word for free really means.
Well, yeah, I mean, it's like the long-standing like business lesson. If something's free, then you're the product, or some variant of it. Your costs are getting subsidized somewhere in the game. All right, so what are the hurdles to this direct securitization framework? Like, why hasn't this been done sooner? What's the significance of this happening now?
Why has it not been done sooner is because the mortgage market likes the little monopoly that we live in. And also the markets that we've been sitting in have been so agency driven for a very long time. I would not be shocked if you start to see agency eligible loans get securitized away from Fannie and Freddie in the future. Okay. And I think, believe it or not, those aggregators would get better liquidity. Also, look, the market was a little bit crazy for the last couple of years, Clayton. Like, think about the uptick of the rates in 2022, et cetera, et cetera. We're starting to see some alleviation. But I mean, I know Powell didn't give anybody the warm and fuzzy about December, in the meeting that just passed either. So look, again, I think different product structures as well, The other thing is, why aren't we done yet with the structure? It takes time to build a structure like that. You want the buy-in of, vast array of stakeholders in the market. You want the bond buyer to be ready for it. You want the rating agencies to be on board with it. You want the Mortgage Bankers Association, for example, to approve it. And you need the lenders to understand it. Nothing that is worth creating happens in 10 seconds.
Now, I'm still chuckling on the Powell mention. I feel like most politicians and business leaders know how to deliver bad news and make it sound good. Powell's the guy who delivers good news and makes it sound bad. And it's like his that presser this week was that was a tough one to listen to.
You guys got to remember though, Powell was not trained as a public speaker, right? That's not who he is. He's an economist lawyer, right? And if you really want somebody who's going to give everybody the warm and fuzzy, you don't generally put that field and background in front of people. But he's the head of the Fed. So what are you going to do? That's who he is.
I think he's also doing what he intends to do. Like, I think he meant to come out and like, hey, we're gonna lower rates. We're gonna hold the balance sheet steady. But I don't want you to get too happy about that. So I'm gonna put some sandpaper in my voice on this one.
But you know what? I think the comment about, housing needs to recover, but we're not going to be that focused on that. They may need to wait a little longer is wrong. He said a very important nugget that I think is beneficial to think about for housing, that the roll-off of the mortgage-backed securities that they have on their balance sheet, he's going to reinvest that cash in short-term treasuries, okay? Well, that means that the mortgage market is going to, in his mind, be recovering on its own. It doesn't need to be propped up as much. And everybody is focusing on, housing will recover is what he said. But again, they're not going to go put another slug of capital into mortgage-backed securities. That's actually a good thing. It means that the competition on the market from buyers should be sufficient for the mortgage industry. And, and you're right, he's not the most politically correct guy in the world, but he's saying certain things that people need to also hear and pay attention to. And I think that's important.
So he said that they start investing in 10-year treasuries. He could have said, and he did not. So let's be really clear here that they could invest in mortgage-backed securities. But even if capital is going into treasuries and they hold the balance sheet steady, does that imply that they'll keep? Do you think? I know you're not like on the Federal Reserve Board here, Jen, but like, do you think that means they'll hold the volume of mortgages steady on the balance sheet, and that like results in less selling?
I mean, if you go and you really look at all the details of what was written and said, they're really only rolling off what's coming to a maturity event, right? Or a cleanup. So it's not that they're going to do like a fire sale of every MBS on their, balance sheet or treasuries for that matter. Things that are naturally rolling off. Now he's going to take that capital and reinvest in something else. And I think that's important. He's not saying MBS is a bad holding. He's saying, I've got this roll-off cash coming and I think I can put it into treasuries now.
Yeah, no, it was a, important nuance to hear in the messaging. So as you interpret that presser and in this move, what do you think that mortgage originators or mortgage investors might be missing or anticipating as they think about the next few months?
I don't know if it's necessarily a missing or not anticipating. I think too much discussion happens regarding rate. Okay. Every rate market, I mean, my grandparents' first mortgage was like 16.75, right? So every rate environment can be productized. Borrowers can be lent to. But again, we're stuck very much. Actually, I just wrote an editorial about it. We are stuck in a very, still 30-year fixed world, even though there are some ARM products out there, 5-1, a 7-1, 10-1 ARM, but we are very much stuck in that 30-year fixed world. That's why it's not working as well for everybody. Okay. Get back to proper product design. And I didn't say go create the option arm loan and give it to everybody, right? But again, the option arm loan for who it was designed for was not a predatory product, right? But when they started giving it to like $25,000 a year wage earners, that's not good, right? So again, create products for specific use cases for, what it's meant and needed for. Give that home ownership back. Floating rate loans are also in a market like this where rates may pothole a little bit like they did. I call it the pothole effect, right? Going over on a road, are not a bad product, especially for that borrower sitting on the sidelines thinking that the rates are going to go down still. So give them the floating rate loan.
But that kind of product innovation and product creativity requires private capital that wants to buy and invest in that.
There is more private capital out there screaming to invest in non-QM than I care to mention, right? And again, non-QM is not a bad word. Some of non-QM is identical to a full doc underwrite of a GSE loan, but they'll allow a different product, like a different property. It's not, there's a ton of money out there, but there's absolutely no interest in creativity, and in a big way. There's creativity in certain silos, but before, I've seen some things come out now, and, Tom's going to call me and scream at me for this. I don't want to see a second lien DSCR loan. I don't want to see it. I helped create the DSCR loan. I know those borrowers well. I know those guidelines. That's not creativity. Creativity is bringing more borrowers to home ownership, okay? Making it so that they can actually afford the payments, right? And non-affordability is really more product driven right now than anything else. And I think that that's important. The housing market was not hugely more affordable before. The rates were just lower.
Damn,
do a little
Jennifer,
more work and everybody can own homes.
That's a swing. I mean, we talk about affordability so much. We talk about two things: asset price and interest rate. We don't talk about product.
Right. Wrong. Right. Hey, rates, unless there's a global pandemic, and yes, Clayton, you can use this video against me if I'm wrong, right, are not going down to 2% again for a very long time. And they should not have stayed in that village of that, 2 to 4% as long as they did. I've heard and had people sitting on trading desks in charge of billions of dollars of loans look at me and go, rates of this level are unprecedented. No, they're not. These rates are actually at a decent level to historical norms. And we're on our way to that, mid to high fives village. And I think that, everybody needs to come to Jesus, that's actually more normal than where we've been.
Well, Jennifer, if we post this clip on Twitter, you'll be joining Logan Mohtashami with the crowd of doomsayers with pitchforks chasing you down and saying, no, it's all rates. But I agree with you. And I think you're onto something here that needs to be a bigger conversation.
Agreed. Yeah.
Jim McGuinness.
I'm with Logan. They can chase us down with the pitchforks. It's okay.
Yeah, especially on this Halloween recording.
We're still going to outrun them, Clayton. My money's on me and Logan.
I'm right there with you. We'll draw the Hordor line right behind you and hold them back in a true Logan Mohtashami-ism. Jim McGuinness, Pivot Financial, thank you so much for joining us. I think we dropped some knowledge today and got into some topics that haven't been hit in quite a while on the Powerhouse podcast. So thank you.
You're welcome. And thanks for having me, Clayton, and greatly appreciate that you did this one-on-one. Have a great day.
You too. Have a great one.